Good morning, Shane. Welcome again to Blue Notes. Thanks for talking to us about the ANZ full year result. It was a solid result in tough operating conditions. One of the things that came out of it, though, was that expenses are growing. Can you take us through what's happening with expenses there?
So our expense growth for the year was 6.8%, which, yes, that's a reasonably large number, but actually a lot of that's impacted by currency movements. And what we mean by that is a big chunk of our expense base sits in other currencies than the Australian dollar. When the Australian dollar falls, as it has this year, that kind of inflates our cost base in Aussie dollar terms. So if we push that aside and just look at it in terms of what's really going on, our cost growth was 3%. That's actually not bad. That's about CPI, about the inflation level in our markets.
And the bank, as you say, it's an international bank. That FX effect outside of expenses, has the lower Aussie dollar been good for the bank?
Yeah, I mean, as a general rule, that's right, because it also, the lower Aussie dollar kind of inflates the value of our businesses that are outside Australia and New Zealand in particular, and so we get stronger revenue growth as a result of that also. And as I said, it's a much, on an average base, it's a net benefit to the group.
In Mike's commentary on the result, he was talking about the credit cycle, credit quality, and he talked about it bouncing along the bottom. You know, can you go into that a bit more deeply for us?
Sure. So the credit environment, as we've seen in most of the markets we operate, but most particularly here in Australia, more recently, the economy has slowed down. It's still growing, but it's growing at a much lower level, and that puts certain stresses on the economy. And we've seen that most pronounced in areas to do with the mining sector, and so that little bit of stress starts to mean that customers have a little bit more difficulty potentially paying things on time, and we start to see some of our early indicators and some of our provisioning start to increase. We've seen that, but what we're saying and what Mike's referring to is we haven't seen a sharp increase in that. We've just seen a gentle increase. It's kind of very logical, it's explainable. Our forecast suggests that we're going to see ups and downs in the period. It's probably more ups than downs though.
So it doesn't raise concerns that we have hit the bottom of the provisioning cycle and it's only going to go up from here?
Oh, I think at some level we have hit the bottom of the provisioning cycle. So I don't know that we're suggesting that it can get any better on that side, but we're just suggesting that it's not going to be dramatically worse. We think it'll just kind of float around these levels for a period of time.
Yeah, and when we look at the composition of the result, a very strong Australian result, very strong result out of global wealth, strong New Zealand result. The one that perhaps wasn't as well, in fact was a bit of a disappointment, was the international and institutional banking business. ANZ is an international and institutional bank. What was behind that?
Yeah, no, that's a good point. About a third of our business is in the retail sectors, about a third is in the commercial and small businesses, and they on average did really, really well. And about a third or a little bit more is in the institutional business, and a lot of that's weighted into Asia, as you quite rightly point out. That's the business that really gets impacted by some of the macro headwinds. So the global liquidity glut we've seen, lower interest rates, the impact of when China made some devaluation of its own currency. All of those things tend to impact that business in a more profound way than others. And so yes, it's had a lot more headwinds than it has tailwinds this year, but it's still a really good business. It's something that there are pockets of that do extremely well, but it's had a bit of a tough time. In particular, actually, Andrew, it was really in that last 6 weeks of the year. It was kind of an interesting period that you get from time to time in that kind of business, but it was really down to that last 6 weeks where it was a lot weaker than we had hoped for.
And again, that last 6 weeks is not the start of a trend then?
No, and in fact, some of our global peers have referred to exactly the same issue. So at the time when the Chinese made some changes to their currency, there were also some changes in the corporate world about a few pretty high profile names having a bit of trouble. That has an impact all across the place. So customers in that event decide to kind of sit on their hands and not do things. So that's one impact. Secondly, it has an impact on corporate credit spreads, and that has an impact on our markets business. So it was a short-term period, that 6 weeks. Time will tell whether that's sustained. I think one more important thing is that even in that 6 weeks, the business remains profitable. It's a good business. It's just not a great business in that environment.
Because there are, within the investor community and the analyst community, there's still people who doubt the worth of the Asian strategy, I suppose. But when you look at that business and the outlook for that business, you're still committed to it.
Absolutely. If you think about what ANZ does, what we do for a living, a big chunk of that is we help customers with their trade and capital flows in the region, and those trade and capital flows today and very likely in the not just the medium term but for the long term are around Asia. That's where 80% of Australia's exports go. Well, we help those exports get to market. We help finance those. and similarly with all the capital flow. So absolutely we're committed to it. It's essentially what we do.
And we saw in the result some commentary around the digital strategy delivering. Is the digital, it's an amorphous sort of phrase, I mean, is that a cost story or is it a revenue story? I mean,
it's both actually, and I think actually first and foremost it's a customer experience story. Customers want to be able to interact with their bank in a really convenient and simple way. You know, one of the CEOs of one of the European banks pointed out that, you know, our busiest branch is the train network at 7 o'clock in the morning, and it's the same for us in Australia. It's the trams and buses. People on the way to work want to engage and do their you know, pay their bills and transfer the money. So digital is about improving our customers' lives through that kind of experience. So that's A, and that in some sense is about revenue growth and grabbing share, but it's also about streamlining the whole process. You know, imagine a world where you can decide to place a deposit or take a loan or buy a piece of insurance on your mobile, and that gets processed straight through digitally without any human intervention. I mean, that is just a fabulous outcome for customers, and that has both revenue and cost benefits to the bank.
Now, ultimately, particularly for the Australian investors, but for a lot of investors, banks are a dividend story, they're a yield story. Given the climate that we're looking at here, are dividends safe?
Dividends, you know, we have a payout ratio at the bank that says we believe that we should pay out about 65 to 70% of our earnings in dividends. We believe that's about right. We're sort of at the top end of that, we're very much at the top end of that range today, but we think the range is appropriate and sustainable over the long term.
Thanks again for speaking with Blue Notes, Shane.
Great, thanks very much, Andrew.